Minister, now as former Kansas City Fed Reserve President and CEO Esther George. It's great to see you this morning. However, of course, we've been talking about what has been a tragedy, a massacre over the weekend in Israel. I don't know how you think that connects and impacts how the Fed may be thinking about our economy, some of the geopolitical and global issues. Why don't we start there?
Well, good morning, Andrew, and certainly a most horrific event that we've witnessed over the weekend. And any time you have these geopolitical events pop up, it introduces an additional layer of uncertainty to the markets and to how Fed officials, I think, will have to think about the path ahead for their interest rate policy.
Esther, on Friday, long before what took place in Israel happened, we were talking about, in the morning, you saw, the futures were down on what seemed like good news on the employment side. Then things seemed to get better, in large part because I think people were looking through some of the sort of straight unemployment numbers and looking at wages and how actually limited that had gone in terms of moving up, and similarly in terms of hours worked. What was your read on that report and how hot things really are or aren't?
Well, we've been dealing with a very tight labor market for some time. And so the surprise, I think, for many of us was to see the strength of people coming back into the workforce in that report, and the fact that the previous months were revised up. At the same time, though, you saw that the unemployment rate held steady at 3.8%. And I think my own take is, as I looked under the covers at that report, you did not see acceleration in wages coming from that. As you mentioned, average hourly work hours seem to be steady there. And I think the good news is you have more people participating now in the workforce. So all of that suggests that some of the momentum that was hitting that labor market may be steadying itself now. It doesn't suggest that that employers aren't continuing to have some challenges around keeping that workforce there. But it's a strong labor market, right, for sure, but not one, I think, that is showing particularly alarming signs in terms of more tightness.
Okay, so put yourself back in the room with Jay Powell and the gang. What would you be saying when they come to you, when they would come to you?
Well, I think as I look at the work of the Fed, they have done a lot over the past year. Inflation looks like, and again, we'll be very interested in this week's inflation report, whether it continues this trend of showing inflation moderating. I think that will be such an important signal to the committee. But I do think this is a time to be very cautious and careful in reading the data that's coming in listening to businesses describe what they're experiencing on the ground. I don't think it is a time to react unnecessarily. And so my own take on this is I think the Fed can be patient right now, notwithstanding the fact that they are very clear they haven't achieved their price stability objective yet.
So the big question has been, do they raise? Do they do nothing? And by the way, 12 months out from now, it's not are they raising or doing nothing? It's actually, are they lowering? Could you conceive of that at this point?
I think if you look at the FOMC participants' dot plot from their most recent meeting, you will see they've kept another rate hike in there. And I read that to mean a signal that they have not concluded that they've achieved their inflation objective. But when you look out into 2024, those rate cuts have been pushed back. And I think that is the signal of likely to expect higher for longer. Once those rate effects really begin to kick in, and I think we have not yet seen the full effect of those, you could expect later next year a situation where they will be in a position to contemplate whether higher for longer suggests they will have to move back on some of those rate cuts.
Esther, when you have an unexpected event like this attack on Israel over the weekend, what's the reaction? What would the FOMC be discussing in that meeting? What were they talking about when Ukraine was invaded by Russia. Does that mean everything else is on hold and you don't worry as much about the data because you look at this larger impact and trying to figure out what the unintended or what unexpected consequences could come from it? Or do you continue to keep your head down and focus on the data?
So I think anytime you have an event around the world, the FOMC not only acknowledges it, but does try to understand what are the implications of that. And you see in the FOMC's own statements following their meetings, they've highlighted the implications of Ukraine and Russia war in the context of what it meant for supply chains, for commodity markets, for oil and gas. And so as they look at this most recent terrible event, I think they will also have to be internalizing what does this mean for the world? What does it mean, particularly watching energy markets, price of oil beginning to tick up there, whether that moves in a meaningful way, I think will be something they'll have to keep an eye on. So yes, always in front of the committee as they think about the multiple factors that they have to internalize in making their decisions.